So, hello, and a massive hello to everybody. Hope everybody's having a great day wherever you are, whatever you may be doing. 50 pips. Here we are for another one of these Substack videos. 5th of October, 2025. No trade calls, no recommendations, responsible and stuff because we're here for educational purpose only. So, just wanted to do a quick update on SPX here. Now, of course, this is a little bit tricky because we could get a lot of headline. We got a lot of headline risk here. We're still in the midst of a government shutdown, so we don't know what could hit the wires. But we're just going to look at this technically just to update what we discussed, I think, since the last video. So here we're in an upside rotation. We're in a market that wants to go higher. In this kind of situation, you'd expect, especially in thin liquidity, a sideways to up chop. You'd expect to see every micro dip get bought for ultimately a continuation of the grind higher. Here it seems that most of the market participants are again thinking every day is a good day to buy because every day we close higher. Every micro dip is worth buying. 7,000 is a given. We're going to close the year above 7,000. So usually when we start to get in this situation, this is where the market tends to have a little bit of a pullback. Now here again on the horizon, unless we get something on the wires, there's nothing to indicate that we should be moving into a prolonged bear market here. Clearly the trend is still up, but here we've got a couple of lights flashing amber. So in our later discussion, we discussed that basically the break above 6,500, there wasn't much holding it back from a move back into the 6,800, 7,000. We've got a lot of confluence of fib targets here. And to the upside, if that goes, just a reminder, the next set of fib targets are 74, 75, 77, 77, okay? But right here, right now, what I wanted to discuss is that we have a lot of things flashing amber, right? And when you see this kind of close here at new highs, unable to attract new buyers, we'd set a high here. They bought the micro correction here. We printed new highs, and this is the second day where we couldn't get any traction. It is usually extremely high odds you'd expect the 10-day moving average to get tagged. So going into the week here, clearly that 6,800 remains resistance to the upside, but I think the turn level remains that 10-day moving average. Watch how the market reacts there. Do we close above? Do we close below? Now, a lot of people like to look at the 21 EMA. If you plot that, you can see that the market's been pretty much catching that. I don't have it on my screen, but again, it's just another way of looking at that trend continuing and every micro dip back into that trend getting bought. Now, as opposed to if we break down, if we start getting a day close below that 10-day moving average, rather than looking at the 50-day, and of course, this previous resistance is going to be support, so that 6,500 is going to be interesting, the 6,600 is interesting, but in terms of psychological levels, and I believe we discussed this before, what I would be focusing on is basically that previous FOMC range, right? And that is on September 17th. That was that latest FOMC meeting. So what you can see is last time, and we discussed this, is on any move back, unless we take out the FOMC day low, it's much to do about nothing. You buy it, it's continuation high, and you see how that level was protected with a higher low. So equally here, I just think lights are flashing amber. It looks like there's a decent chance, unless a headline comes out, that we're going to tag the 10-day moving average, and that 10-day moving average is going to be pivotal for either aggressive buyers to come in and continue higher, or for us to unwind back towards that FOMC day low. That's what I'm looking. I think if we close below on a day close basis, then you can pretty much forget in terms of bigger picture all these other references to the downside. I think that opens up the bigger correction. And again, you've got a lot of levels around that 6,200, 6,100, 6,000. And keep in mind that a correction back into there, right now they're gagging to buy even a micro dip. So correction back into that zone is 10% correction, if you want to call it. You'd expect to see very aggressive buying coming in, protecting here. So unless something really drastic has changed, just on a technical move, just on a liquidity move, should we get that kind of move, that should be buyable. And that's, if you're bullish, that's probably the nicest little setup here into October that tends to see some wobbles, get a chance of that big of correction to buy, and then ride it back for that year-end seasonality and that March higher. So I think that's the bigger picture view if we start getting traction below that FOMC day range. If not, as we stand here, off those highs back into that FOMC day range, that's about a 3% correction. So that's kind of like standard run of the mill. Every quarter you tend to see that 3 to 5% correction. So you'd expect buyers to come in and protect that, right? And whether that kind of overshoots a little bit and the buyers come in at the 6,500 into that level protecting it, that's pretty much what I'd be focusing on. So the two key supports would be one, and then the broader zone to the downside. Now, I think one thing which is interesting to keep an eye out for, and we've been flagging this, is, this move higher is really being led by the jokingly flight to safety into tech or into growth, right? But something which is interesting is if you look at the way Fangman has been behaving here, and this is the old traditional Fangman, so Apple, Tesla, actually, no, I got the wrong one up. The traditional FanMax, so Microsoft, Amazon, Netflix, Google, Facebook, Amazon, Netflix, Google, Apple, and Microsoft, you can see that this is being flashing amber, right? It's breaking down. Now, even if you replace Netflix and you add Google, you add NVIDIA and Tesla, right? So adding Tesla and NVIDIA, you could see that this is also breaking down, right? So this is like the big weights of the indices, whether you're talking about XLK, and these are big weights. So if money's starting to come out of these and these start to get wobbly, you have to be a little bit careful. Now, of course, you have to keep in mind the market, this could just be a rotation, right? A rotation out of growth into value. So if you look at something like VTI, the weights are very similar to SPX. And case in point, you could see we've got the same negative closes we got on SPX. So what you want to look at is you want to look at something like RSP, right? So an equal weight. And what do we see on RSP? You could see that on RSP, this is broken those highs, even though we got some selling at the end of into the end of the week. But so breadth is improving, market is money's moving into other names. So one thing you want to watch out for is keep an eye on YM and Russell, right? So again, Russell failed once again at those highs, even though it's broken out, but you saw some selling coming back into YM and Russell at the back end of the week. So as I said, they're amber flashing rights on SPX. And I think the key tell, the way you can look at it is if you get a situation where you're just seeing that unwind out of tech, money moving out of tech, and moving out of growth and moving into value, what you'll probably see is you'll see that YM and that Russell continue to catch a bid. You'll continue to see that RSP holding strong, even if you get SPX moving back and touching that 10-day moving average, but that should probably hold it, right? Now, on the other hand, if you get a situation where that weight in tech is still there and the money is not flowing into everything else, so it's not flowing into YM and Russell, then watch out below because it could open that bigger air pocket and that key test, which is all about those FOMC day range lows. Okay, hope this was useful, guys. Have an awesome one. Talk to you guys soon. All the best. Bye-bye.